Good afternoon, everyone. My name is Anuja Shah, and I work at Center for Environmental Law, Education, Research and Advocacy, National Law School of India University. Welcome to the another session of Advanced Contracts. Today, during the stint of my presentation, I will be taking you through the enforcement of liquidated damages and some of the landmark judgments precluded by the Supreme Court of India with special reference to government contracts. Before we head towards understanding the enforcement of liquidated damages, it is cardinal to understand the formula applied by courts for awarding damages. Friends, my question is to you. Is there any statutory general formula for calculating and awarding damages? The answer to my question is an absolute no. Because even courts rely on the general principles set by case laws and precedents while awarding damages, and it ultimately leads to lengthy litigation process. So in this session, let us explore the possibility and desirability of deriving a general formula for calculating and awarding damages. Section 73 to 75 of the Indian Contract Act 1872 deals with law of damages. It is dealt under Chapter 6. Specifically, Section 73 and 74 of the Indian Contract Act deals with unliquidated and liquidated damages. What are liquidated damages? When the agreement between the parties stipulates the sum payable for non-performance of the contract, damages are said to be liquidated damages. And what are unliquidated damages? Unliquidated damages are awarded by courts or arbitral tribunals on assessment of the loss or injury caused to the party who is suffering from the breach of contract. So if you want to claim damages under Section 73, that is, if you want to claim unliquidated damages, there needs to be a contract, its breach and loss or damage following such breach is of such a nature that it is anticipated by the parties at the end of entering into the contract. On the other hand, if you want to claim damages under Section 74, that is, if you want to claim liquidated damages, there needs to be a contract containing provisions for compensation or penalty in case of its breach by either of the parties to the contract. So this is how you can claim damages under Section 73 and 74 of the Indian Contract Act 1872. But there are other essentials that needs to be followed for claiming damages. The prima facie essential is there has to be a breach of contract. Very, very important. Unless there is a breach of contract, no damages can be awarded. The second essential thing is proof of loss for claiming liquidated damages. You have to provide a proof of loss. You have to provide an evidence of loss. In the court of law, for claiming liquidated damages, an aggrieved party will not be awarded liquidated damages unless and until an evidence has been submitted in the court of law. We'll discuss about it in the further slides. The third most important requirement is causation, which means there has to be a link between the loss suffered by the aggrieved party and the breach of contract. So if there is a breach of contract, there has to be a loss come what may, otherwise damages will not be provided. And the most important point is, fourth essential is mitigation, which means every party who is breaching the contract should mitigate the loss suffered by the aggrieved party. He has to cover the loss that has been incurred by the aggrieved party in such a way that no contract has been performed. Like, had the contract not been performed, the aggrieved party would not have been in that situation. So these are the four essentials that needs to be performed if you are claiming liquidated or unliquidated damages. So once it has been ascertained as to what kind of damages are to be awarded, one has to begin evaluating the same in monetary terms. Have you ever wondered why are we laying emphasis on coming up with a general formula for calculating and awarding damages? The primary idea behind coming up with a general formula to calculate and ascertain the damages is to ensure that value expected by the plaintiff or aggrieved party from the breach of contract is made good to them. But you must always consider one point which is very, very important, that the damages awarded should not exceed the actual loss or injury suffered by the plaintiff or aggrieved party. Now, Section 73 of the Indian Contract Act 1872 does not provide for any manner to calculate the damages or compensation, following which the Supreme Court of India has laid down that damages are to be calculated on the basis of facts and circumstances of the case. However, if you take a look at Section 73, there is a flavor of general formula for awarding the damages. You'll find that essence in it. If you consider Section 73, damages would mean total loss minus mitigation of loss minus remote loss. Please consider Section 73. Please consider the formula that is available on screen, and you will easily understand the importance of ascertainment of market price to calculate the damages in case of breach. In majority of illustrations, in majority of case laws and precedents, market price is considered as a base price for calculating the amount of damages to be awarded in case of breach of contract. Now, if you apply this to a parallel study of Hadley versus Bexendel, a very, very important judgment, will not be discussing the facts of that case in this particular presentation. However, I request you all to go through that case law. One can conclude that Section 73 provides for recovery of damages which are arising in the usual course of business resulting from the breach. Have you ever wondered from where has this idea of garbing down a general formula for calculating and awarding damages come from? The first feature in legal environment regarding the formula to calculate and award damages can be found in law of merchant, also referred as lex mercatoria. It is nothing but a commercial body of rules and principles laid down by the merchants to regulate their dealings back in 1303. Principle 7.3.2 of Lex Mercatoria is on calculation of damages, and it states that party who suffers a loss from the failure of the other party to deliver is entitled to damages, and they are typically measured by the market value of the benefit of which the aggrieved party has been deprived through the breach of contract. It also says that the aggrieved party can calculate the loss based on the difference between the contract price and the price of a replacement transaction concluded within a reasonable time and in a reasonable manner. So the principle is primarily built on the preposition to fully compensate the aggrieved party, to compensate the losses which are sustained by the aggrieved party by specifying two important formulas. The first formula is damages is equal to amount to have been received in case of performance of contract minus amount actually received from the party breaching the contract plus cost of measures undertaken to keep the aggrieved party in a position it would be had the contract been properly performed. If you look at this formula carefully, you'll understand that Indian courts have religiously followed this formula. In majority of case laws and precedents, this formula has been applied. The second important formula is damages is equal to replacement transaction concluded by the aggrieved party within reasonable time and manner. This is basically based upon Articles 75 and 76 of United Nations Convention on Contracts for the International Sales of Goods. It is also referred as CISG. So when you look at these two formulas, have you ever wondered whether it has been reinstated in any of the commercial codes or international conventions? The answer is yes. This formula has been reinstated in Principles of European Contract Law, in UNIDROIT Principles of International Commercial Contracts 2016, and in UK Sales of Goods Act Chapter 4. However, due to development of national commercial codes, the principles of lex mercatoria or law of merchants have declined to have an independent existence. But its principles were the basis of several national codes and still finds its relevance to date, because there are many national codes who have actually implemented the principles that were laid down in lex mercatoria. I'm sure you all might be waiting for me to slurp up the discourse on liquidated damages. But please note, it is extremely significant to understand the general formula for calculating and awarding damages before heading towards enforcement of liquidated damages. So let us move towards infrastructure project contracts and building contracts. In most of the infrastructural projects, the Supreme Court has suggested the use of Hudson Formula to calculate and award damages. We'll definitely be discussing about Hudson Formula in detail. It's extremely important. But given the enormity and dynamic nature of infrastructural projects and the quantum of risk and stake involved in it, it is extremely important that the rights and obligations of the stakeholders involved needs to be precisely laid out in order to promptly estimate and calculate the value of the project. This is to facilitate the disputing parties to ascertain mathematically relevant amount of damages duly supported by the documents and evidence. In an infrastructural project contractual dispute, the claims for compensation, apart from the value of variations based on rates and prices in the bill or scheduled rates in the contract, can be referred as head office overheads. This is a very important term because we'll be discussing certain formulas, and in every formula this term has been used. Head office overheads, which can further be divided into two categories. One is dedicated overheads and other is unabsorbed overheads. So when you talk about dedicated overheads, it is specific to the delay caused by an employer. So whenever any delay is caused by the employer, it is known as dedicated overhead. And when you talk about unabsorbed overhead, it is usual contractor expenses like rents, salaries, etc. So these are the subheads of head office overheads. Now the Supreme Court of India has noted the observations made in Hudson's building and engineering contracts that in contracts which are pertaining to competitive tendering at the national level, and considering the evidence given in many such occasions, suggest that the head office overheads and profit would come up to 3 to 7% of the total price of cost that is added to the tender. Therefore, courts on many occasions have allowed for compensation under the head of loss of profits in addition to and over and above the actual claims. So this excerpt is taken from one of the landmark judgments, which is McDermott International Inc. versus Burns Standard Company Limited and others. In this particular case, Supreme Court had observed Hudson's building and engineering contracts, and it had followed the formula of success. So formula of success is so there are basically three formulas which we'll be discussing. So Supreme Court had followed the formula of success that actually has been evolved for computation of a claim for increased overhead and loss of profit due to prolongation of the works. So let us quickly take a look at the Hudson's formula. This formula was actually given by United Kingdom and is acclaimed to assess delay damages in an infrastructural project. So the formula is O and P into contract sum into period of delay divided by 100 into contract period. Now if you take a look at the screen, O and P refers to head office overheads and profit percentage in tender or the contract. While applying this formula and head office overheads, or you would say O and P, are considered as per the contractual agreement. They are usually taken into consideration as per the contractual agreement. Although this formula has been used in several judgments, it has been overlooked because of the fact that it depends on the tender in dispute, and also due to the fact that the calculation is dependent on the number which itself would contain an element of head office overheads and profits, which would amount to double calculating. That is why this formula is usually not regarded and has been not completely but to some extent it has been overlooked because of this element of double counting or double calculating. I can absolutely understand the amount of complexity involved in understanding these formulas, because even when we were law aspirants, it was very difficult for us to understand the application of these formulas, especially because it has been applied in United Kingdom and then Indian courts have also followed it. But yeah, I'm sure it will take some time for you to understand these formulas and um, uh, the elements that are involved in it. But I would request you to look at the formula and then read the context so that you will be able to cope with what has actually been laid down. So we were talking about Hudson formula, and I would still say, in my opinion, this formula is used by many lawyers in variety of arbitration proceedings, especially in the contractual disputes with reference to infrastructural projects. And this Hudson formula has actually led to two other important formulas. So let's discuss the second formula, which is Emden formula, which is again very similar to Hudson formula. You will find that it resonates Hudson formula to quite an extent. So this formula was also originated in United Kingdom, and it calculates the head office overheads and profits that could have been achieved on a different job elsewhere, and it applies it to the whole reimbursable period of delay. So this formula is, you can see, it is quite similar. It is almost the same as the Hudson formula. It's O&P into contract sum into period of delay divided by 100 into contract period. So here, when again we are talking about O&P, it refers to heads office overheads and profit percentage. Although the Hudson formula and Emden formula both resemble each other, the major difference is that in Hudson formula, the head office overheads and profit percentage are calculated based on the tender numbers. Whatever numbers are available in tender, that will be taken into consideration. On those basis, head office overheads and percentage is calculated. Whereas when you talk about Emden formula, the same is calculated on the basis of actual numbers. Here actual number is taken into consideration, which makes this formula even more reliable, and a lot of courts, not just in India but even abroad, have applied Emden formula to calculate the damages. So let us head towards the last formula of this segment, and indeed the most complicated one, Eichleay's formula, that originated in United States of America. While calculating damages, this formula does not take loss of opportunity into consideration. Friends, the formula is very much available on the screen, and I request each one of you to note it down for your clarity and understanding. We'll definitely be analyzing this formula. So if you look at the complex calculation under this formula, it clearly considers that if a significant proportion of final contractual valuation is made up of value of variations, say more than 10%, 20%, whatever is the value of variations, then an adjustment needs to be made to the formula to consider the fact that variations themselves would be contributing to the head office overheads and profits. This formula is usually used when it is very difficult or almost impossible to give the proof of loss of opportunity and claim is based on the actual cost. Friends, if you look at the formula on the screen, it says that total head office overhead during the contract period is first determined by comparing the value of work carried out in the contract period for the project along with the value of work carried out by the contractor. Now that is allocated the same ratio and expressed as a lump sum to the particular contract. Friends, here the amount of head office overhead that is allocated to the particular contract is then expressed as a weekly amount by dividing it by the contract period. The period of delay is then multiplied by the weekly amount to give the total sum that is claimed. This formula is widely used even in United States. The Eichleay formula is given a lot of significance by Federal Court Circuit. The Federal Court Circuit of America believes that this formula is the best formula for compensating a contractor for overhead expenses. So whenever there is a matter of compensating overhead expenses, Eichleay formula is usually used, especially in the United States of America. So we will not delve much into the technicalities of these three formulas, but this was just to give a brief overview of the fancy formulas that are laid out, especially for calculating the overhead expenses. Alright friends, then let us quickly move to the most interesting segment of this presentation, that is liquidated damages. We'll study about origin, evolution, and present situation of liquidated damages. If you talk about origin, you'll understand that liquidated damages can be extracted from common law. You'll find elaborate discussions in the judgment of House of Lords, and one such judgment is Dunlop Pneumatic Tyre Company Limited versus New Garage Motor Company Limited. In this particular judgment, it was held that provision of liquidated damages will be enforceable only at the time of making the contract, where it is very difficult to determine the damages that would accrue if a contemplated breach occurred. So basically, it was held by the court that when there is difficulty in assessing the damages that are to be provided in the event of breach, then liquidated damages will be provided. Now, keeping pace with the gradual commercial progression, the United Kingdom Supreme Court recognized the necessity of liquidated damages in one another judgment. It is called Cavendish judgment. The courts in this particular judgment had laid down the vintage law on liquidated damages that was crystallized in Dunlop case. Court said that whatever test has been laid down in the Dunlop test is quite inadequate because of the complexities involved in commercial contracts. When you look at the modern commercial contracts, there are a lot of complexities involved, and Dunlop test on liquidated damages is not at all adequate. The courts found that Dunlop tests can be used merely for assessing ordinary damages. Now please note, ordinary damages are different from liquidated damages, and that could no longer be considered sufficient to deal with liquidated damages clause of a more complex variety found in contemporary standards. Friends, I've already discussed about liquidated damages under Section 74 of the Indian Contract Act 1872. If you want to get clarity and understanding on liquidated damages, it is better we take a look at Black's Law Dictionary definition. They have laid down in a very simple language that an amount contractually stipulated as a reasonable estimation of actual damages to be covered by one party if the other party breaches is called liquidated damages. So if you clearly take a look at this definition and try to understand it, you'll come down to conclusion that liquidated damages is nothing but a pre-estimated damage which the parties agree to while making contract or entering into the contract as likely to arise at the time of breach. So whenever there is a breach, such kind of damages will be awarded. They'll be clearly written. There will be a proper liquidated damages clause in the contract. They'll clearly jot down that clause. And whenever there is a breach by one party, the other party will be liable to pay damages as per the written clause. Whenever the courts are dealing with liquidated damages, which are to be paid by one party to the contract to the other, they usually consider Section 73 and Section 74 together because it gives clarity and understanding on providing damages. Why are damages awarded? Damages are awarded to compensate the aggrieved party, right, from whatever breach has occurred. But at the same time, it is very important to understand that aggrieved party should not be allowed to make unjust enrichment under the garb of claiming compensation out of breach. किसी पार्टी का लॉस हुआ है तो उतना ही पैसा देना है. You cannot give more money, because if you're giving more money than the loss, it would amount to unjust enrichment. ऐसा ना हो कि जिसने ब्रीच किया वो लॉस में चला जाए and the other party has lot of money, because that would amount to what? Unjust enrichment. Very, very important term. And Supreme Court had emphasized a lot on this term. In Indian Oil Corporation Limited case, Supreme Court had come up with a policy called no damages, no loss policy, which means whenever there is a breach of contract, there has to be some sort of loss. If there is no loss, no damages will be awarded to the aggrieved party or the plaintiff. This is a primary rule, and I think also in my first slide while I was discussing about essentials to claim damages, I had clearly said the prima facie point is there has to be a breach of contract, and when there is a breach of contract, there has to be a loss suffered by the aggrieved party. So this is the requirement. Loss is essential. It is mandatory. Now that we have understood that actual loss or damage is prerequisite or sine qua non for awarding liquidated damages, let us head towards understanding some of the examples of liquidated damages. Friends, I really want to clarify this. Damage and damages are different. Damage is the injury, is the loss incurred by the aggrieved party. So whenever there is any sort of loss, that is a damage. Damages are compensation, award that has been provided to the aggrieved party. So the letter S makes a lot of difference. So please don't confuse damage with damages. So before we head towards understanding the examples, let me ask you another question. Are liquidated damages analogous to penalty clauses? For a layman, yes. Penalty, damages, compensation, everything is the same. But from a legal perspective, being a lawyer, you should know difference between each and every term, each and every legal jargon that is being used. So yes, there is a thin line of difference between liquidated damages and penalty clauses. Liquidated damages is a pre-assessed loss agreed to between the parties at the time of entering into the contract or making a contract. So it is basically something that the parties jot down, and They presume that it is likely to arise at the time of breach. On the other hand, when you talk about penalty clauses, it is the stipulation to award an imposition which is so unreasonable, which is so excessive, which is so disproportionate that no prudent person would consider it as reasonable assessment of damages arising out of breach. So basically we can say that liquidated damages represents reasonable stipulation of likely losses, whereas penalty is far from being reasonable and is usually intended to secure the performance of contract. So intentionally, the amount will be so high that it will force the other party to not breach the contract. Securing the performance of contract is very, very important, and for that, penalty clauses have been formulated. Intentionally, the amount is high so that the other party will not breach the contract. So that is the thin line of difference between liquidated damages and penalty clauses. So now my major question to you is, when can liquidated damages be enforceable? Liquidated damages can be applicable only and only when there is an acceptance of performance. I'm sure you all might have, by now you all might have understood acceptance, promise, offer. So when there is acceptance of performance, there is going to be a legit contract between the two where they can jot down liquidated damage clause, and then you know the entire process, right? But what if the contract is terminated after sending the notice for liquidated damages? Can they still be claimed? The answer is yes. It can be claimed despite the termination, but only till the date of termination. In certain situations, whenever there is a delay, the contract automatically gets terminated or it is terminated by the other party. So, in such circumstances, can the liquidated damages be provided? The answer is yes. Liquidated damages can be provided given that the proof of loss or evidence of loss is presented in the court of law. Now, see, this is the second essential. While I was talking about essentials to claim damages, the first one was breach of contract and loss. The second was proof of loss. And there I had clearly mentioned that proof of loss or evidence of loss is extremely important when you are claiming liquidated damages. So even if there is a delay and the contract is terminated, you can ask for liquidated damages, but for that you will have to provide the proof of loss. But now the major question here is, if you look at construction projects, say if there is a project or contract on construction of road or a bridge, and if there is a delay in completing the construction of road or a bridge within a stipulated period of time, will it be possible to provide liquidated damages? Because in such situations, it is actually very difficult to prove the actual damage or loss suffered by the party. So what should be done in such circumstances? That is the prima facie question. Because courts have mandated that yes, if there is no proof, if there is no evidence, will not provide liquidated damages. But not providing evidence in case of construction projects, is it reasonable? Should courts provide damages in such situations? We'll discuss this in the further slides because there is a very interesting landmark judgment, and that will give us a clear idea that what should be done in case of construction projects.